Imagine you're sitting at your kitchen table, going through the mail, and you come across a headline on your phone that stops you cold. IRS just set a $600 threshold on checking accounts. Your first thought is probably the same one most people have. Does that mean the IRS is now watching every deposit I make? Every time my Social Security payment lands? Every time a family member sends me money for a birthday? Every time I move money between my own accounts? Is all of that suddenly being reported? If you've seen this claim floating around online, in a forwarded email, or on social media, you're not alone. It's one of the most persistent pieces of financial confusion circulating right now, especially among retirees and Social Security recipients. And because it touches something deeply personal, your bank account, your privacy, your hard-earned money, it's the kind of headline that's almost impossible to scroll past. So let's slow down and actually look at this carefully. Because here's the truth. The claim in that headline isn't accurate. But the story behind it, how this rumor started, what actually happened, and what rule did change recently is worth understanding. Not because your checking account is suddenly under surveillance, but because knowing the real story protects you from unnecessary fear and helps you recognize which financial headlines deserve your attention and which ones don't. By the end of this video, you'll know exactly where this $600 rule idea came from, what's true and what isn't, what actually did change in 2026, and how any of it affects you if you're receiving Social Security, a pension, or other retirement income, why this matters. Here's why this is worth 5 minutes of your time. Misinformation about the IRS spreads fast, especially among people living on a fixed income, because the stakes feel high. If you believe the government is tracking every dollar that touches your checking account, you might start making decisions based on fear instead of facts. Some people have actually changed how they manage their money, avoiding direct deposit, keeping large amounts of cash at home, or refusing help from family members because of a rule that was never actually put into place. That's the real cost of this kind of confusion. It's not just an inaccurate headline. It can change how people behave, sometimes in ways that create more risk, not less. So let's clear this up properly, starting with where the rumor came from in the first place, where the $600 checking account rumor started. Back in 2021, the Treasury Department floated an idea as part of a broader tax compliance proposal. The idea was this: banks would be required to report a single number to the IRS each year for every account, the total amount of money that flowed in and the total amount that flowed out, for any account with more than $600 in total annual transactions. Notice what that proposal actually described. It wasn't about the IRS reviewing your individual purchases, your medical bills, or your grocery trips. It was a single yearly summary number, total deposits, total withdrawals, meant to help catch large-scale tax underreporting, primarily aimed at wealthy individuals and businesses hiding income. Even so, the backlash was immediate and intense. Banking groups, privacy advocates, and members of Congress from both parties raised concerns. Critics pointed out that a $600 threshold was so low, it would sweep in nearly every American with a bank account, including retirees living on Social Security. Because of that reaction, the proposal was significantly narrowed, and eventually it was dropped entirely. It never became law. It was never implemented. Your bank has never been required to report your account totals to the IRS because of this proposal. That's worth repeating clearly. The checking account monitoring idea from 2021 never took effect. If someone tells you this is currently happening, they're describing something that was proposed, debated, and abandoned years ago. The rule that people often confuse with it. Here's where things get genuinely confusing, because there's a second, completely different $600 rule that people often mix up with the bank account proposal. This one involves something called Form 1099-K, and it applies to payment apps and online marketplaces. Think Venmo, PayPal, Cash App, or Etsy, not your checking account directly. The background: if you sell items online or get paid through one of these apps for goods or services, the company processing that payment has historically had to send the IRS a form, a 1099-K, summarizing what you received, but only once you crossed a fairly high threshold, more than $20,000 in payments and more than 200 separate transactions in a year. In 2021, as part of a different piece of legislation called the American Rescue Plan Act, Congress lowered that threshold dramatically, down to just $600, with no minimum number of transactions required. In theory, that meant even a modest amount of income through a payment app could trigger a reporting form. But just like the bank account proposal, this change ran into serious practical problems. The IRS delayed it, then delayed it again. There were plans to phase it in gradually, $5,000 for one tax year, $2,500 for the next, with the full $600 threshold eventually taking effect. If you've seen headlines about a $600 threshold over the past few years, this is almost certainly what they were referring to. Here's the important update. In the summer of 2025, new legislation reversed this change completely. The $600 threshold for these payment apps was repealed, and the rule reverted back to the original, much higher threshold, more than $20,000 in payments and more than 200 transactions. So as of right now, that lower $600 reporting rule is not in effect either. If you occasionally sell something online, get reimbursed by a friend through a payment app, or receive an occasional payment for a small side project, you're very unlikely to trigger any new reporting requirement. There's another part many people overlook here. Even this rule, when it was being discussed, was never about your checking account. It applied specifically to payments processed through third-party apps and marketplaces for goods and services. Personal transactions, someone paying you back for dinner, a family member sending a gift, splitting a vacation cost, were never meant to be swept into this reporting requirement in the first place. What this means if you're receiving Social Security or a pension. That brings us to something equally important, how any of this actually touches your day-to-day finances if you're retired or receiving benefits. If you're receiving Social Security, a pension, or retirement account withdrawals, none of what we just covered changes how that income is reported. Social Security payments are already reported to the IRS directly by the Social Security Administration. Pension income is reported by your pension provider. None of that depends on any $600 threshold, and none of it is affected by the proposals or rule changes we just walked through. If you're not running a side business, not regularly selling goods through an online marketplace, and not using payment apps to collect business income, there's really nothing new here that applies to you. Your bank is not sending the IRS a running log of your deposits and withdrawals. Your Venmo transfers with your grandkids are not being reported as income. Your checking account is not under some new form of surveillance. Let's say, for example, you sell an old dining table on Facebook Marketplace, and the buyer pays you $400 through a payment app. Under the current rule, the $20,000 and 200 transaction threshold, that single sale wouldn't come anywhere close to triggering a reporting form. Or suppose your daughter Venmos you $150 to help cover a shared grocery bill. That's a personal transaction, not income, and it was never intended to be reported in the first place. Common misunderstandings worth clearing up. There's one important exception worth mentioning, because it's where genuine confusion sometimes creeps in. If you are running a small business, say you do some freelance consulting, sell handmade crafts regularly, or drive for a rideshare service, the rules around reporting that income haven't disappeared. You're still required to report business income on your tax return, whether or not you receive a 1099-K form. The form is simply a paperwork trigger for the payment platform. It was never what determines whether income is taxable. That obligation exists regardless of any threshold. Another misunderstanding worth addressing directly. Some people assume that because a proposal was in the news, it must have eventually passed. That's a reasonable assumption, but it's not accurate here. Plenty of tax and financial proposals get floated, debated publicly, and then narrowed or withdrawn before ever becoming law. The 2021 bank account monitoring idea is a clear example. It generated a lot of headlines and then quietly disappeared from the legislative agenda. The next point matters if you've seen this claim shared by someone you trust, a family member, a friend, or even a well-meaning post online. Misinformation doesn't spread because people are careless. It spreads because a claim sounds urgent and plausible, and it touches something people already worry about, like government overreach into personal finances. That's exactly why it's worth pausing on financial headlines like this one and checking them against a reliable source before reacting. What you should actually do. So what's the practical takeaway here? A few simple things. First, if you come across a claim about a new IRS rule, especially one that sounds alarming, take a moment before reacting. Check it against the IRS's own website, irs.gov, which publishes official guidance and updates on reporting thresholds and rule changes. That's the most reliable place to confirm whether something is actually in effect. Second, if you're managing money for yourself or a loved one, and you occasionally use a payment app for small transactions, don't feel pressured to change your habits because of this rumor. There's no reporting threshold on personal transactions like gifts, reimbursements, or shared expenses. Third, if you do run a small side business or regularly sell items for profit, keep good records regardless of what the current 1099K threshold happens to be. That's simply good practice, and it protects you whether or not you receive a form from a payment platform. And finally, if something you read about Social Security, Medicare, or IRS rules feels off, or seems designed to provoke worry rather than inform you, that's often a signal to verify it independently before acting on it or sharing it further. Dotlet quotes bring this all together. The idea that the IRS has set a new $600 threshold for monitoring checking accounts is not accurate. That specific proposal was floated in 2021, drew significant pushback, and was ultimately dropped. It never became law. What people are often actually thinking of is the $600 reporting threshold for Form 1099K, tied to payment apps and online marketplaces. That rule went through years of delays and phase-ins, but as of the most recent legislation in 2025, it's been repealed and reverted back to the original, much higher threshold of $20,000 and 200 transactions. Neither of these rules involves your checking account being monitored. Neither affects how your Social Security or pension income is reported, since that's already handled directly by the agencies and providers issuing those payments. And neither applies to ordinary personal transactions between friends and family. It quotes, completely understandable to feel a jolt of concern when a headline suggests the government is watching your bank account more closely. Money, and the sense of privacy and control around it, matters deeply, especially when you're relying on a fixed income. But the more accurate picture here is actually reassuring. The alarming version of this rule was never put into effect, and the related rule that did exist has since been rolled back. If you ever want to double-check something like this for yourself, irs.gov is the most reliable place to look, and it's worth bookmarking for future questions about your specific situation. Tax rules do change from year to year, so when in doubt, verifying directly with an official source is always the safest approach. If this video helped clear up the confusion around this topic, consider giving it a like, and subscribe if you'd like more clear, accurate breakdowns of the financial and benefits news that affects you. And if you know someone who might have seen this claim and felt worried by it, share this video with them. A little clarity goes a long way. Thanks for watching, and I'll see you in the next one.